Okay, hey everyone, my name's PK, and I've got with me here actually a very special guest. His name's John Manchomelli. I don't think he actually needs an introduction, but in this video, we're going to be talking about how to maximize your borrowing capacity. I know so many of you, you may already have one property, two properties, three properties. You're thinking, how am I going to build a portfolio? How am I actually going to get the requisite number of properties so I can achieve that passive income? I'm being stopped by the banks again and again and again. Our friend here, John, who's actually a client of mine as well, we work very closely together, very experienced in the industry, is going to be sharing with you some golden nuggets. So if you haven't heard of him, like you're in for a treat. So he's been a mortgage broker for almost 20 years. He's been on Sky News. He's, an experienced property investor himself, for about 20 years, he's been investing in property. A couple of personal things, which by the way, I like to introduce people for who they are, not what they do. So, John is a massive Alfa Romeo fan. I'm a massive Alfa Romeo fan. He's actually half Italian. I'm not, but I feel that Indians and Italians have some sort of vibe. They love food. They're very sweaty people. They're very hairy people. They're very passionate people. There's some sort of vibe there. So we may or may not talk about cars, but really in this video, I want to deep dive with John's permission on how we can help you guys actually get some huge gold nuggets to get that next property, not be capped out by the banks. And John has some amazing connections with a plethora of banks, tier 1, tier 2, tier 3 across Australia. So he'll be sharing with you some things that you probably don't know. Okay, so without me kind of fluffing on too much, John, I don't know if that intro did justice to you, but do you want to sort of maybe give your background a little bit more, or anything else that I missed?
Oh, you did a great job, PK. Thank you. Thank you very much. I'm a bit humbled, to be honest, how you've done it. So yeah, again, I also wanted to say thank you for getting me on your podcast. I really appreciate the opportunity to share a lot of the wisdom, and it's mainly from the mistakes that I've made over the years as an investor. I think that's the wisdom that I bring, but we're going to talk a bit more about what I do professionally. I think when it comes to loan serviceability, it's a combination of making sure you find the right broker, and then there are some bits and pieces that you can do to improve your serviceability. So if that's all right, PK, can we have a bit of a blend of both?
Yeah, I mean, let's do it. Just when we were chatting offline as well, I was saying to John, can we just really deep dive on how to maximize serviceability? And he said, actually, the choice of finding the right broker is kind of, not decoupled. It's, joined at the hip with that answer. So yeah, please, John, go ahead. And I want everyone who's watching, listening to really connect with this video or this episode, because it's going to be a little bit different. There's actually going to be a lot that you can take out of it.
Yeah, thank you. Thanks, PK. So when it comes to deciding on the mortgage broker that you want to work with, a lot of it is going to influence your borrowing capacity in the years to come. And I say that because experience is king. When the experienced broker can anticipate changes, will understand loan time. So at this time of the recording, one of the issues is how much time it's taking to get a loan through. And it may mean the difference between you securing a property or not. But experience is fundamental. And at this stage in the industry, about 50% of mortgage brokers who have around the 18-month mark are leaving the industry. So there's a fair bit of knowledge that gets lost if you've decided to work with someone that's not as experienced. But experience is king. And it's because an experienced broker starts developing a relationship with lenders. And what happens is your submission, when it gets put up, if it's recognized by the lenders, they start to look at that as going, John's been around a while, or Bob's been around a while, and if he thinks it's a deal, we better take this seriously. The other thing too is a mortgage broker who specializes in investing is really important. Just like a solicitor may specialize in migration services or criminal law and so forth, what you'll find is mortgage brokers are generalists. So they'll do a first home buyer call over here, and then they'll do an upgrader, an owner-occupier upgrader over here, and then they'll do a car loan. And to some degree, I do that as well. But when you get 30 emails a day from the 30 lenders that you're accredited with, it's impossible to retain everything. So if you can find a broker who specializes in investing, when they get that email in saying that they've just reduced the bank assessment rate for investment, can you see how all of a sudden that becomes very pertinent for your 5th and 6th acquisition? So finding a broker that can specialize in investment property is really good, because they'll understand the credit policies around investing and how to get you to that next level, right? And then also internal and external resources. A good broker should have internal staff. I remember the days when I was brokering and it was only 6 to 8 hours to get a loan from application to settlement. It's now 26 hours. And so it's important.
So just to connect to that point, so you're saying that for someone, if I come to you and I want a loan, by the time we had that conversation to the point of settlement or settling that property, you've done 24 hours of work for me?
Yeah, because it's insane, right? The Royal Commission has made it so much more harder, rightly or wrongly. The banks now need a broker to go through line by line your expenses. COVID meant that a lot of the offshore teams had to move back onshore. So it's just a lot harder. And so the days of a broker working on their own is over. I mean, they can still try, but they're working very hard. And the way you can tell that is if your broker picks up the phone when you call, or just calls you back within an hour. Okay. And so having internal and external resources are really good. So the external resources could be the referral partners to tradespeople to renovate, solicitors, financial planners who do risk insurance. I never refer my clients to a financial planner for property advice, obviously, but risk insurance should be part of your plan.
Yeah.
So so that's just a brief touching on why you should find a broker who specializes in investment property. All right. Yeah. So moving on to maximizing serviceability, I've got quite a bit that I can talk about. Got 11 points. So I've got some notes here. If I'm looking down, it's only because I'm looking at some notes. So one of the things you can do, guys, is instead of looking at the interest rate you're paying, ask your broker to find out what's the bank assessment rate. All right. So for example, at the time of recording this, ING have got really, really good rates and very, very quick turnarounds. But at the moment, they're terrible for investors trying to develop a property portfolio. All right. So the way they conduct living expenses analysis in relation to income, and then their higher assessment rate, it's just not conducive to investment. I'll help you with one or two, but beyond that, it may not be the lender for you. Okay. So assessment rate's a really good one. Yeah. And your broker can help you understand that. All right. The obvious ones that you may have heard of is reduce your credit card limit. Okay, even though you may not owe anything on that $30,000 credit card limit, the bank will take 3% of the limit and take it away from your after-tax salary to help to fund a hypothetically maxed out credit card. Yeah. Okay. So if you've got some credit cards and you're not using them, a suggestion is just get rid of them or lower them down to a limit that can get you across the line. Okay. And which extends to buy now, pay later. That recent phenomenon, just get rid of them if you can. They are still seen as a liability, even though you may not be using them.
So like if people are using Afterpay or ZipPay, all of that is actually tracked. All of that is actually going to be penalizing you in terms of your loan.
That's right. Yeah, because the bank just assumes that you're going to max it. You're going to use it. It's going to be some sort of debt commitment.
Right. Okay.
And actually, that brings me on to the next point that I haven't got in my notes here. We're entering into a new area of positive credit reporting. So this is going to be exciting because if you have shown that you've got good credit, there will be an opportunity down the track, and it's starting to happen now, where you'll get offered better rates and better serviceability and so forth. All right. So if you do have an interest in this space, just keep an eye out on positive credit reporting, because that will make a difference for us investors.
Yeah.
All right. Now, your credit history, guys. Make sure you go to mycreditfile.com.au and clean your credit history. Before you even go to a bank, just make sure there's anything that is on there, you just remove it. All right. It's, I can't remember what the fee is if you want your file straight away, but it's only 3 or 4 days for you to get it for free. Mm-hmm. So mycreditfile.com.au, I have no affiliation with them, but it's just a way for you to check to make sure that you haven't got any issues that the banks will see.
Yeah.
And unfortunately, I have seen some ID fraud around telephone bills. We applied for loans and the bank said, hey, you know, you've got an outstanding Optus bill of $1,000. And my clients are like, what are you talking about? So it's a really good idea to do that. And your broker can do that if you give them permission to have a look at your report.
Okay. It's a really good one.
Now, it goes without saying, if you can roll your debts into one at a lower rate. So if you've got a car loan and a personal loan and some other loan, and if you've got equity, then a really good idea is to set up a second loan, you know, where you're being charged 3% interest at this time of recording, instead of, you know, 10% on that personal loan. It's a really good way to consolidate the credit card. But you want to make sure that it's a second loan, it's not in your actual home loan, so that you pay it down. You don't roll it out for 30 years as well. Is this good, PK?
This is amazing. I mean, I'm sure. I mean, I have conversations with investors every single day, and all these things that you're mentioning, you know, people have personal loans, people have credit card loans, people use Afterpay, people go to the, you know, the local mortgage broker and ask them what is the cheapest interest rate that they can get. What you're saying is like all the opposite to all that sort of stuff. So it's interesting. Of course, we can't deep dive into everything, but you know, if anyone's watching and they do want a deep dive of any of these 11 points that John is making, you know, please drop a comment, mention that point in the comments below, and we'll be sure to expand upon it in a future video. But this is gold, John. Please carry on.
Okay, cool. Thank you. Living expenses is something that the banks are really scrutinizing now. And I've got some classic stories, mate. You wouldn't believe the stuff I get asked by credit assessors. It's come back a little bit now, but just after the Royal Commission, I had one bank ring me and say, how many kebabs is this guy having? Are you for real? The other one was
night 3 a.m. kebabs.
The other one was how much dog food.
So they're going to this level of detail. They're actually checking the bank statements. It's not like a cursory look. They're actually investigating everything. It never used to be like that, right?
Yeah, it never used to be like that. Just on Friday, we're recording on a Monday. This bank was asking why her declared food expenses was at X amount, and yet on her bank statements, it was substantially higher. And so they said, no, we're not approving it until you explain that. And so the explanation came back was she's living with a flatmate and she bought all the groceries and the flatmate pays her back. So I can't begin to tell you, just rein in the living expenses 3 to 6 months before you actually think about making that acquisition. If you know there are some things that you don't need, then just get rid of it. So it's not on your bank statements, because if it's in your bank statements, they will question it 100%.
So the takeaway is to reduce the living expenses. Of course, you should reduce them as far as possible into going concern, but most importantly, 3 months before applying for a loan. Is that right? Yeah,
ideally 6, because the software I send out will bring out a 6-month statement.
Yeah,
and we have to go through it. All right. So yeah, it's common sense anyway to rein in expenses. The 5th one that I've got is the type of loan. Now, there are some lenders where if you fix your loan, they will actually use the fixed repayment. So a lot of your viewers may not know that the banks will put a buffer above what you're paying if it's a variable rate loan.
Yeah.
So there may be consensus at this time of recording to take advantage of the delta and fix some of the loan, because it's about a 0.5% difference between fixed and variable.
Yeah.
So sometimes that could be the difference of getting that extra property, because you're fixing the loan and the bank goes, yep, bang, it's all. If you've got 5 investment properties and you're paying 3% interest and it's now 2.5% and you fixed all of them for a year, it might be enough to get you across the line.
So I understand this, John. So obviously fixed loans, point of recording are most often cheaper than the variable. But what you're saying is that they're not going to add that, 2% buffer on top of a fixed loan. So they're actually going to lend you so much more money if you just wholesale fix all your loans. Is that what you're saying?
Yeah, so it's not every lender.
Okay.
So there's so many lenders out there that what they do is they go to market with their own little niches and credit policies. And this is where it harks back to finding a broker who specializes in what you're doing.
Yeah.
So there are lenders who will go, yeah, we'll just take the fixed repayment amounts because we know it's not going to change.
So when it comes to finding like a good broker, John, I just really want to understand this because, I've got you here. Why is not every broker just like you? Why do some brokers not open themselves up to all lenders? Like, it just seems logical for me that if there's so many lenders and they have all these different policies, a broker would try to understand all of them and give their client the best service. Why is it that some brokers only focus on 5 lenders or 10? Like, this is a bit of an ignorant question. What's your view on that?
I don't know, PK. I don't know. I think just from experience, I know it's too hard to be a jack of all trades.
Right.
And everyone does try and do that because they're so desperate for work. But a broker is juggling so much. They're out there trying to prospect for work. They've got work in the books already and they've got to maintain that. There's just so much communication that goes on. Anyway, one file might mean an email to an assessor, to a solicitor, to a real estate agent, back to the client. That's just 4. And if you've got 10, that's 40 emails that's already gone out. So, it's a massive juggle. Hence the reason I'm saying if you want to do development finance, there are brokers that are much better than me that do development finance.
Sure.
I can do it, but I'm not the best at it. There are brokers out there that are perfect for first homeowners.
Yeah.
Okay. And so just like anything in life, if you find a doctor that specializes in something, they're obviously going to get very good at it.
Sure. Got it.
I'm not sure if I've answered your question, PK.
No, it makes sense. So you find someone that specializes in property investing, not a jack of all trades, because they're actually going to know what they're doing. I think that's my takeaway.
Yeah. All right, some other tidbits that we could touch on. If you've got genuine savings, the banks like to see it sitting there for 3 months. Okay, and the good news is even if you borrowed that money, so long as it's sitting there, there are some lenders who will actually take that as genuine savings.
Okay. All
right, so if it's a gift or if you actually taken a personal loan, so long as it just sits there for 3 months, that's an ideal period of time.
Okay. So it could be equity from another house that's just there in an offset account as well. Would that qualify?
Just a personal loan? Yeah. I mean, that too, obviously, but even a personal loan. So if you're really struggling to get started and you've got an amazing job that's paying you good money, but you've just been paying all this rent and you're finding it really hard to save because of your lifestyle, or you're just paying a lot of rent, there are lenders that will take that personal loan of $30,000, and so long as you can service the personal loan and the investment loan, they will look at that. Interesting. Okay. All right. All right. Now the other one is raise your income levels. I know it sounds obvious, but I've heard of brokers that encourage their clients to move in with parents. Yeah. And rent out their owner-occupied premises on paper. So there's a suggestion where I've seen that work quite well. Sure. Okay. So that's one way to increase your income. The other one is lenders that take 80% of your rental income and not just 60%. Mm-hmm. So you think that'd be obvious, but that's another way to increase your income by just focusing on those lenders who'll say, you know what, we'll take more of the actual rental income rather than the lower amount. Yeah. Yeah. So, I mean, the thing is that there's so many layers, right? Before you were saying that if you switch to fixed interest loan, then they're not going to put that 2% buffer for serviceability calculators. And then there's a set of lenders that do that. And then a set of lenders which do what you've just said. Now
So that's the whole idea of getting a broker, because they can then see, it's like Tetris. You're trying to find a lender that kind of fits the bill in all these layers. You can't do this yourself. So, I mean, that's just a plug for mortgage brokers in general, but it's kind of really coming to life as you're talking.
Yeah, thanks, PK. It's a moving environment all the time. So I'm sure when this comes out in the future, one of these lenders I'm talking about has changed their policy, because they have risk mitigation teams.
Yeah.
And sometimes they're flush with money and they want to push money out hard, and their risk teams are saying, let's go after investors now. And then there might be something that comes up where the risk team comes out and says, let's stop lending to investors. Yeah. And so it's fascinating. It's really fascinating. The other one I wanted to mention that we talked about off air was the common debt reducer loans. So common debt reducer loans, what are they? Now, in a normal environment, when you take out a loan, 100% of the debt is attributed to you, even though you may have taken that out with a partner, whether it be your husband or wife, or just with a friend, okay? And they'll only take 50% of the income. So you've got all the debt associated with your partner, but sometimes it's as low as 50% of the income. Yeah. Okay. So there are these wonderful credit policies called common debt reducer loans, where if your partner can supply payslips to prove that they can repay their portion of the loan, then the entire debt is no longer applied to you anymore. Right. Okay. So they're called common debt reducer loans. So that might be the one thing that stops you from getting that additional loan, because you're all of a sudden you're still made to pay the 100% of your partner's income. Yeah. Okay? And there's a whole bunch of environments where it's stopping you. Your partner may have lost his or her job. You may have gone from contracting, from PAYG to self-employed IT contracting. Mm-hmm. There's a whole bunch of things which may stop you from moving ahead with that person, and you want to go by yourself. Okay.
Does that have any relationship with who actually owns the property? Like, is that type of loan applicable only if, let's say, my wife and I have jointly own a property and have used both of our serviceability to buy that property and get a loan? Or is it equally applicable if, let's say I own it, but I've used both of our borrowing capacity? Could you just, do you know what I mean?
Yeah, that's a good question. That's a bit grey, but to keep it simple, let's just say that your wife's credit score is bad now, for something that wasn't her fault or whatever. You could move forward and still buy an investment property, provided the serviceability is okay, because remember, we're buying positive cash flow properties, hopefully. You can still move forward and not worry about your wife's low credit score.
I see. Yeah.
So there's lots of permutations around this common debt reducer.
Yeah.
But ask your mortgage broker anyway, and he or she.
And is that a common thing, John, the debt reducer type of loan? Or
no, it's not.
I've never heard of this term before. It's a new thing, or has it always been around?
It's been around probably for the last 3 or 4 years, but because people focus on interest rates. Yeah. I want the cheapest interest rate, and everyone does, but behind that, you want the cheapest interest rate is going to get you to that next investment property. Yeah. And so we're now starting to find lenders who will help you with some strategies that they've come up with. So common debt reducer being one of them, which leads me to a couple of other strategies. All right. I could talk about this for hours.
This is amazing. And guys, everyone who's watching, if this is actually bringing you value, and if you actually want John to kind of expand on these things in future videos, because I know so many struggle with getting borrowing capacity, leave a yes below, YES, and that will just give us some feedback. And then I'll see, if we get 20, 30, 40 yeses, then I'll know that we have to definitely bring John back to expand upon it. I'll leave it to you guys, but these last 2 or 3 points, these are actually like the game changers. I'm personally really excited to hear these as well.
So thank you, PK. Yeah, so common debt reducer loans is something to look at. The other one is, I can't give advice around self-managed super funds, but talk to your financial planner or your accountant about using your super to try and get you that next property. Your accountant or financial planner will put a plan together and say, yep, let's get some of your super to go into property or into shares or to gold or whatever it may be. Okay, so everyone keeps forgetting, there is this super there. All right. So just quickly, you can go up to 80% of the value of the property. Interest rates will be higher at the time of recording, around 4.5%. So your self-managed super fund needs to put up 20% at least, plus costs. But what an amazing way to get another property, an incredibly tax-efficient strategy for you in retirement as well. So that's another one.
100%.
The other one too is I've got a lender who really exciting. I couldn't believe it. Great story. The state manager of this lender was very humble. Came into my office with her business development manager talking about why I should send all my clients to them. And being a broker that focuses on investment property, I said, tell me investment property solutions. That's what my clients want to know about.
Yeah.
And so I couldn't believe it, but they were saying that if your portfolio is looking like it's positively geared, okay, and you're struggling, what they said to me was, we will still need to have a look at pay slips, but that becomes secondary. So if your portfolio of properties is generating, I don't know, $100,000 a year, okay, in income that's coming in, and only $60,000 a year is going out,
yeah,
then they see you as a professional property investor. And so long as your portfolio is paying for itself, so long as you keep buying properties that are neutrally geared at least, or positively geared ideally, then whilst they will still ask for your PAYG's pay slips and tax assessments and all that sort of stuff, that's secondary. Okay. So there's this wonderful environment at the moment where if you've got a positive cash flow property portfolio and you're struggling, then this lender wants to talk to you. Okay. Now the interest rate won't be that cheap. It'll be 3.5% at the time of recording.
Yeah.
Okay. But as you become more sophisticated, it's not about the rate. It's about getting the next acquisition that in 10 years time, 3 to 5 years time, you taught me, is going to be 150 grand more.
Yeah. Yeah.
Okay. That's just from the top of my head, mate.
No, I mean, but that's phenomenal. I don't want that to just kind of, be kind of like a whimsical statement. I want everyone to connect with that. So what you're saying, John, and I'm putting words in your mouth here for a second, is this one lender, maybe there's others, I don't know. At least for now, there's this one lender that if you buy a positive cash flow property and it's giving you net income, net of all costs, everything, maintenance, everything like that, they are willing to loan you more money to buy another positive cash flow property. Yes, interest rates are not going to be in the 2s, they're going to be in the 3s, which you can still buy positive cash flow property right now, even despite that interest rate. And that way, it's almost like, I mean, I have not been investing for like 20, 30 years like you, but, 20 years ago, or even 10 years ago to some degree, you could buy positive cash flow property and you could take that to the moon. That's why we have these books on 0 to 200 properties in 10 years. And not that that's what you need to do, but, those principles which were kind of thought of as archaic, or that's like the good old days of property investing. Are you really telling us, John, that this lender is willing to bring those good days back?
Yeah, I mean, they're always there though. But their caveat, this particular lender, they're saying that it needs maximum LVR at 80%. So, if you've done well because you've done PK's course and your LVR is now at 50%, hey, it's there. It's definitely there. Right. And it's funny because I fell off my chair when they told me this. Yeah. I said it 3 times back to them. And they went, yep, I know. And the next day I emailed them. I said, I want it in writing.
Got to get that in writing.
I called them again last week.
That's phenomenal, right? So like if someone has, let's say 80K in the bank account, that is enough to buy a 350, maybe 400K property on an 80% LVR, 20% deposit. Not only is the positive cash flow going to be higher because you put in 20% deposit, but because it's positive cash flow, that's going to allow you to get the next property, and then you basically rinse and repeat. Now, of course, you need the growth. So you can't just buy in super regional areas where the data doesn't stack up, because without the growth, you're not going to get the equity for the next one. But so long as you can have that equity, so long as it's positive cash flow, you can build out a large property portfolio, and you don't need an income of what, $400,000, $300,000. People in there, what would you say? This is kind of a loaded question, John, and I know there's shades of gray, but if someone wants to build, let's say, a $2 million portfolio, talking gross,
Yeah.
what is the kind of household income that they need to achieve that? I know it's a difficult question.
Yeah. I mean, it obviously comes down to lifestyle, expenses of that person, but you'd be surprised the average person can do it. All right. I'm assuming the average person doesn't have the big showy car leases or, the big credit card limits and things like that. But, a teacher and a nurse, I mean, two normal incomes, if that's the right word, $80,000 each, you'd be surprised. Yeah. The problem is we all get fixated that we need to buy in Sydney for $1 million where the yield's 3%.
Yeah.
Doesn't have to be the case. And unfortunately, we just get bombarded with general media that says you can't do it. It's just that everyone starts off with, I've got to buy in the suburb I live in, which in Sydney or Melbourne and pockets of Brisbane now, it's not that cheap.
Yeah.
But we can find those other suburbs. And, I think everyone would like to thank you, PK, for making data accessible, because you've done a wonderful job of making data accessible to the Australian community, investor community, Matt. So on behalf of everyone, I'd like to thank you, PK.
No, I mean, my mission's
so
always,
much.
Thank you, John. And my mission's always been the same. Passive income is what we want. We don't need the Ferrari or anything like that. Although a couple of Alphas are nice.
What's that?
A quadrifolio to definitely get you to sleep at night a little bit better. But we don't need that stuff. We just need passive income. We need freedom. And I really just want to emphasize that point that you made. You don't need to be a surgeon. You don't need to be a neuroscience scientist. You don't need to be an investment banker. You don't need to be anyone like that to be able to build a $2 million property portfolio. And guys, that's really all you need, because if you build a $2 million property portfolio, it takes you 2, 3, 4, 5 years to do that. You hold that bad boy for 10 years. That is your passive income for life, right? After 10 years, that is your income for life. Anyone can do it. You need to be disciplined. It's not for people who, then want to go buy a brand new car off the dealership for $80,000. Although that's probably what you and I have done, John. But
but we've done it. We've sacrificed. We've done the hard yards, and we've gotten to that point. And I'm not saying I'm anywhere near as you, because I've done so many mistakes. Every mistake under the sun, you come to me and I'll tell you I've done it. All right. I have listened to the wrong people my entire life, but still managed to do reasonably well. But that's the beauty of property, right? When you get old like me, property can do wonders. But but some amazing stories. I remember helping a single mother with 2 kids. We got her a positive cash flow property, $140,000. It wasn't anything flash, but it started spinning off some cash.
Yeah.
And it's gone up to 190,000. So there's a bit of equity there now for her to continue her journey. So yeah.
And it's a throwaway statement, right? 140 to 190, but that $50,000 is it's probably like 150% return on investment, cash on cash. Cash on cash, it's phenomenal return. You don't get that stuff, I don't know, even in Bitcoin or something like that. I'm not an expert, but it's phenomenal. So, I mean,
PK, can I something a little bit different? Maybe it's a podcast we can do another time, but we're all about cash flow. And I was wondering if in your days in banking, if you ever got exposed to renting shares out or writing covered calls as a strategy.
Renting shares out, I mean, what we were involved in, not me personally, but the company that I worked for was like you could say an entrepreneur in this. JP Morgan, it was credit default swaps. So that was basically a derivative of a derivative, like almost making a share instrument from mortgage loans. I'm sure you know about that.
I've heard of them. I'm not across it completely. But anyway,
but it's a little bit different from renting shares out. What do you mean by that exactly?
There are ways where you can buy shares and do a covered call on them,
Mhm.
And the ASX in Australia has said that the best way to make money in the stock market is to write what's called covered calls. And I call it the renting share strategy. So you bought it's like buying a house outright and you just rent it out.
I see.
And anyway, I've deviated too much, but I just thought something you might have been exposed to in the past.
No, I mean, let's continue the conversation, guys. If you want to hear John again, please let me know in the comments if there's any topics that you want us to deep dive on. Like I don't know all mortgage brokers in Australia, but having been an investor and being in the industry for more than 10 years, I know that there are lots of good mortgage brokers and lots of, you know, not so good mortgage brokers. John's definitely elite. He's top of the pack. And I think the best thing about John, you can see it in his eyes, you can see it in his countenance, is that he's humble, right? Like, I don't care how much money you guys want to make. I don't care how many clients I'm going to say no to and have said no to before. I like to work with people who have humility because I genuinely think that's like the crest jewel virtue that human beings can possess. So I'm kind of bigging you up here, John, but like this is actually the first time we've spoken in this kind of format. So let's do many more of these.
Yeah.
And let's really try to maximize people's borrowing capacity, because that's, you know, lending strategy is as important as where to buy. Everyone on Google, YouTube, where do I buy? What's the best, you know, boom suburb? I'm guilty of that, clickbait, but borrowing capacity, maximizing borrowing capacity is as important. John, is there anything else that you wanted to say?
I'm so humbled by you, PK. Someone of you. Thank you, mate. Look, I've got lots of great ideas, really great ideas. And I would say that anyone who's involved in property is almost as involved in the finance game, because it probably just happens to be the conduit to getting you the cash and the capital growth. But it's the finance at the end of the day that's going to help you get there or pull it out. So there's lots of wonderful strategies that we haven't even started on. But I'm just so grateful to you, PK. You talk about humility. Oh my goodness. You are literally transforming people's lives because you're educating people, and that's what you love to do, and that's what I love to do. And yeah, thank you, mate. I can't believe how much I've learned doing your course. This is not plugging you, I know, but anyone who's thinking about doing it should really do it, because I said to PK off air, you're too cheap.
I always say on these videos that my course isn't a cheap one, but so no, thank you for saying that. I really appreciate it, and I'm really looking forward to having you back as well. So guys, look, if this video brought you value, please hit the subscribe button. That I actually get to see that reciprocation, that energy. Hit the like button, give it a thumbs up. That way we realize that this is actually bringing you value. We're not doing these videos to market ourselves. I hope we're trying to do this genuinely to bring value. When you give value to the world gives you value back. All right. So, you know, that's how the world goes around. So hopefully this actually brought you some benefit. This is John Manchiamelli. You can Google him. He's been on Sky News. And he probably doesn't want me to say that. I want to get on Sky News at some point. I don't know how we do that, but my name's PK, and catch you later, guys. Bye.